What's up, beautiful people? Welcome to the channel that is empowering you with the knowledge to help you build generational wealth. My name is Mia, and I reveal the financial education that we did not learn in high school. Alright guys, so we might not have gotten much of a financial education growing up, but let me tell you, there is a lot of financial advice out there today. Every time I scroll through Instagram and even TikTok, it's like new experts are popping up all over the place. And after I watched this one TikTok video that really made me think, like actually crunching numbers type thinking, I was like, idea? This would be great to bring to the channel and dissect for you guys so that you know whether the financial advice you are receiving from social media is fact or cap. Okay, so before we dive into today's feature, let me break down a brief background on 15-year and 30-year mortgages. For most, the standard mortgage loan term is 30 years, so you would pay your home off over the course of 30 years. Well, there is also a 15-year mortgage option, which gives you the opportunity to pay your home off sooner. With a 15-year mortgage, you will pay your home off in half the time, which is awesome in theory because your mortgage typically is your biggest bill. Who wouldn't want to get rid of that and own their home in its entirety? Well, in order to pay your home off sooner, it's going to increase your monthly mortgage. That's just kind of how math works. In order to pay something off sooner, you have to pay more on it. So in order to incentivize the 15-year mortgage, banks offer lower interest rates on them. And if you remember from any of the videos in the Credit 101 playlist, the lower your interest rate, the lower your cost to borrow the money. You want a lower interest rate. All right, now let's see what this guy has to say about it.
Up to 1.1
Hey,
million
Curtis.
right there. Yeah, what's up?
Can you please explain why a 15-year mortgage is a bad investment?
Yeah, because that's exactly what the banks want you to do. But let me show you on the whiteboard. So you've been lied to, you've been cheated, you've been manipulated by all the idiots in the world who try to convince you to get a 15-year mortgage. You don't believe me? Let's ask Mr. Lumberjack right here. As an example, if you get a $300,000 mortgage for 15 years, you're going to pay roughly $2,000 per month. In this scenario, your money is now working for the bank. They're going to dangle a little carrot over your head saying you're going to get a lower interest rate and you're going to save up to $83,000 of total interest. However, what they failed to tell you is if you would have got a 30-year mortgage, your payment would have been around $1,250. Now you have $750 of cash flow, and now that money can be working for you. If you got that money compounding for you in the same amount of time, it could be worth up to $1.4 million. The $1 million manipulation in plain sight.
$1 million manipulation? Let's see about that. So I've already run the mortgage numbers, actual mortgage numbers, and not theoretical mumbo jumbo. So on one side you have a 30-year mortgage using the same $300,000 example, and I'm illustrating with a realistic rate that you can find in today's market on average. And on the other side you have a 15-year mortgage for the same $300,000 with a lower incentive rate. Now, super quick, your real mortgage will consist of your principal, interest, and your home insurance and property taxes. If you don't put enough money down, depending on your loan type, it could also include PMI, which is mortgage insurance. Now, for the sake of this comparison, we're just looking at the difference between the loan values, but your real mortgage will be more than just principal and interest, okay? Okay. So, with a 30-year mortgage, you are looking at a monthly payment of $1,347.13. With a 15-year mortgage, that payment increases to $2,043 and a penny. That's a difference of $695.88. However, with the 15-year mortgage, you will pay almost $700 more a month, but you will save $117,226 overall. And you can see that here with the difference between the total interest payments on a 30-year loan versus a 15-year loan. This right here, knowing that you can save over $100,000 instead of paying that in interest to a bank is why 15-year mortgages are glorified. But what he's saying in this video though, is instead of paying that extra $700 for a 15-year mortgage, you can invest it instead and make millions. So let's run those numbers. If you're starting with the $0 invested over the course of 15 years, we will use a conservative rate of 8%. We will leave it to compound annually and invest that $695 at the beginning of each month. Mortgages are typically due on the 1st, and when you invest does matter. Timing and investments are everything. As you see, when you change the contribution to the end of the month, your earnings do decrease. So let's leave that at the beginning of the month. And as you can see, after 15 years, you have invested over $125,000 and have earned $111,186 in interest. If we compare that balance of $236,445 to the $117,000 savings based on the 15-year mortgage, well, numbers don't lie, and I would much rather have invested that difference. And if you know me, then you know that I've already taken this analysis a little bit further and determined if I could pay my house off, keep investing, and where that would take me. But let's keep this focused on the $1 million manipulation. So after 15 years, we're looking at roughly $240,000. Where we're getting $1.4 million? So let's up the return rate to more along the average of the S&P 500, and after 15 years, we get this. Okay, so now we're looking at the same $125,000 invested, and we've earned upwards of $200,000, giving us a balance of $300,000. Looking good, but not $1 million worth of good. So let's do this analysis over the course of the entire 30-year mortgage. If you invested $695.88 over the course of 30 years, whoo, now we're talking. Okay, yeah, I like that. Let's lower the interest rate and see what it would look like at a conservative, below average return. Okay, so our ending balance falls just short of $1 million, but it's very close. So I would say that this TikTok advice is fact, no cap here. Granted, he left off a lot of important details like interest rates and return rates when he uses calculations, but after running the numbers myself, for someone who has considered the benefits of a 15-year mortgage, I would definitely reconsider. Because after 15 years, I could still pay my home off and continue investing and be so much better off if I paid myself versus giving that extra money to the bank. I would love to hear your input. Anybody who would typically prefer the 15-year mortgage, please let me know in the comments if after seeing this you would opt to do it differently. You guys know I'm an advocate for investing, and whereas I can't recommend specific investments, I can run all of the analyses and show all of the data points that indicate with facts the benefits of investing. Alright, you know the drill. If you see some advice out there and you want to know whether it's fact or cap, please send it my way. This was so much fun for me. Like this video because it helps my stats, subscribe because it helps yours, and your girl has started podcasting, so go check me out if you want your weekly dose of motivational, real-life financial education. Until the next time.